Welcome to question 58, and you'll be very happy to know that this is the last question in your revision kit. So, yes, as you can see, there are two proposals, right? It looks like either it could be an accusation of merger or it could be a reconstruction question, looking at the background of it. Now, as you can see, this is very lengthy. There are so many requirements are here. Okay. So sometimes you might be asked many requirements worth less marks. Sometimes you'll be asked only 2 or 3 requirements, but the marks will be more. Okay. But the layout, the structure, the length of a 50 marks question will be same only. It's not that some are very big and some will be small. Okay. So first, let's prepare a report for the board of directors of Nente company. First one, estimate the current value of Nente share using the free cash flow to firm methodology. Okay. Estimate the current value of Nente company share using free cash flow to firm. 7 marks. So estimate, the word estimate says that this is a calculation. This goes in your appendix. So appendix 1. Then second. So this is you are planning already, you are planning the layout of the report. This will go in appendix 1, this will go in appendix 2, this my calculation will be here. I will be writing on the report like this. All this should be going at the same time when you are reading the requirements. Second, estimate the percentage gain in value to Nento share and major company share under each payment offer. So that means there may be a different payment offer. Okay, so under each you have to estimate, again this is an estimate calculation. Okay, percentage gain in value to a Nente share and this share, both Nente and this one, under each payment offer. 8 marks. Coming to the third one, estimate the percentage gain in the value of a follow-on product. Again this is an estimate, so this is again a calculation part. Percentage gain in the value of a, when something is written as percentage gain, it is not enough for you to find a gain, you have to find in terms of percentage. You should know that. So estimate the percentage gain in the value of a follow-on product to a Nento company share based on its cash flows and on the assumption. So based on cash flow and on the assumption that the production can be delayed following the accusation of the exclusive right of production. Production can be delayed. What does it mean? There's an option to delay. Option to delay is what? It is a real option. So you can see that we also have a real option here. Fourth one is discuss. It is a, you have to write. So discuss the likely reaction of Nento and major shareholders to the takeover offer. Of this also you have to write, of them, the shareholders you have to write, of the takeover offer, including assumptions. Whenever they say including something, make sure that that part is there. Okay, assumptions in the estimates made above and how the follow on products value can be utilized by Nente. Okay, professional marks for that. Coming to B and C. B and C are separate standalone questions. It is not a part of a report. So B, estimate, evaluate. Okay, evaluate the current value of Nento. So current performance of Nento and comment. Just evaluating is not enough. You have to comment on that performance, on what this will mean for the proposed takeover bid. C, since the approach to Nento Major has itself been the subject of a takeover bid from another company, a listed company which specializes in supplying machinery to the manufacturing sector and has a market capitalization of this much. What do you have to do? Evaluate the general post-bid defenses. Post-bid defenses, okay? So I'm assuming that you know what are the post-bid defenses. This question is a accusation and a merger question. Looking at the word post-bid defenses, I can tell you. So reading at the requirements, you know this is a question on accusation and merger, because post-bid defenses comes in accusation and merger only. And comment on their suitability for measure to try to prevent the takeover from this one. Okay. We'll see whether we can cover all in this video or not. If not, then we'll put it in part 2. Part B and C will go in part 2. Okay. But part A will be covered in this video for sure. because when I make a video, I never plan that I will make take 1 hour, or because when I plan, then I have to rush through, which I don't want to do, because I never compromise on quality. Even though the length of the video is more, I let it be like that, because there are things which I cannot ignore and I have to tell. So I don't want to put it in 1 hour or 30 minutes. If I want, I could have done that also. That's the reason you see my videos are very long. It goes long. You will never see such long videos. Usually people try to get all the points. They try to finish it as soon as possible. So my thing is not to finish as soon as possible. My thing is to make you properly understand each and every single thing, so that you can never have any doubt. Rarely I see students after seeing my video asking me any further doubts on that. Rarely. Maybe 1%. Not even 1%. It's very rare. So that means I can assume that they are understanding from the first instance, they're understanding to my video. That shows that I'm doing a great work, right? So let's read. Nente is an unlisted company. So Nente is an unlisted company. Very important that you mark it as an unlisted company. Designs and develops tools and parts for specialized machinery. The company was formed 4 years ago by three friends who own 20% of equity capital in total. How much they own? 20% of equity capital in total. The three friends, and a consortium of 5 business angel organization which owns the remaining 80%. So 5 business angel, they own 80% in roughly equal proportions. Nente has also had a large amount of debt finance in the form of variable rate loans. Initially, the amount of annual interest payable in these loans was low and allowed Nente to invest internally generated funds to expand its business. Okay. Recently, though, due to a rapid increase in interest rates, there has been a limited scope for future expansion and no new product development. We know when interest rate increases, cost of borrowing increases, and you cannot take much loans and all for expansion, future expansion. So no new product development. Now, board of directors consisting of 3 friends and a representative from each business angel organization met recently to discuss how to secure the company's future prospects. 2 proposals were put forward as follows: proposal 1 and 2, and you are given the financial information also, if you see the scheme, and also the statement of financial position. So let us start with the proposal 1. To accept a takeover from Minjo, a listed company. If you see, Minjo is a listed company and they were unlisted company. So to accept a takeover offer from, which develops and manufactures manufacturing tools and parts. Same. Okay, same line of business. The takeover offer is for $2.95 cash per share, or a share for share exchange where 2 major Meiji shares would be offered for 3 Nente shares. Nijo would need to get the final approval from its shareholders if either offer is accepted. Now, this is a part which is not done well by most of the students, especially this takeover offer. When the offer is in different things, like it could be for share, it could be for share, it could be a converted share where you can convert the convertible debt where you can convert to shares later. But this question you have to be very familiar. It is a key question in your acquisition and merger. Key question. You cannot ignore it. Cash per share is an easy thing. That still it is justified. The way the candidate's performance is justified in that. But the problem lies in share for share exchange. To find the number of share. Okay, so it is this per share or a share for share exchange. What is it? 2 shares for 3 Nente shares. 2 for 3. Coming to proposal 2. To pursue an opportunity to develop a small prototype product that just breaks even financially but gives the company exclusive right to produce a follow-on product within 2 years. So it also gives exclusive right to produce within 2 years. It's a small prototype, and in addition to that you have a right, okay, option to follow on product. The meeting concluded without agreement on which proposal to pursue. After the meeting, Major was consulted about the exclusive right. Major directors indicated that they had not considered the right in their computation. They have not considered the rights. You know that an option to the real option has a value and it needs to be valued, but here they didn't value it in that exclusive right. In their computation, they were willing to continue with the takeover offer on the same terms without them. Okay. So even without their right, they are willing to continue with the takeover offer on the same terms. Now, currently Major has, okay, so they have 10 million shares in issue and they are trading at this 4.8. Major company's price earning ratio. PE is 15. It has a sufficient cash to pay for Nente's equity. Okay, it has sufficient cash to pay for their equity and substantial proportion of its debt, and believe that this will enable Nente to operate on a PE level of 15 as well. So Nente's PE, okay. In addition to this, Major believes that it can find cost-based synergies. So what is the cost-based synergies? It is 150,000. This is the synergy after tax per year for the foreseeable future. And Minju's current profit after tax. So you have been given the current profit after tax for the Minju's. And also the financial information related to Nente and the development of new product is given below. Now let us go to here. In arriving at the profit after tax amount. Okay. Nente deducted tax allowable depreciation and other non-cash expenses totaling this one. Deducted tax allowable depreciation and non-cash expenses totaling this one. So what do you have to do? To reach in that profit after tax, they have deducted tax allowable depreciation and non-cash expenses totaling this much. Okay, it requires an annual cash investment of this one in non-current assets and working capital to continue its operation. Okay, a working has to be done here. Adjustment. Okay, this information is there for you to adjust that profit after tax. That means you cannot take profit after tax 620 as it is. Some adjustments need to be done. Or sometimes the information is there but you don't have to adjust. You have to decide whether it is an adjusting figure or you don't have to adjust. But in this case, it looks like you have to adjust. Now, Nento's profit before interest and tax in the first year of operation was this one. So profit before interest and tax for Nento. First year is this 970,000 and have been growing steadily in each of the following 3 years to their current level. Nento's cash flow grew at the same rate as well. But it is likely that this growth rate will reduce to 25% of the original rate for the foreseeable future. We have to know how much it is growing at. Now, Nento currently pays interest at what? 7% per year. Okay, why they are giving the 7% cost of debt? 380 basis point over the government base rate. Okay. And corporation tax is 20% on profits after interest. It is estimated that an overall cost of capital, so cost of capital is 11%, is reasonable compensation for the risk undertaken as an investment of this nature. Now coming to new product development, which is proposal 2 only. Under proposal 2 only, this is okay. This is not a separate thing. So developing that new follow-on product will require any investment of this. This is investment. The total expected cash flows and present values of the product over its 5-year life with the volatility. Volatile is 42%, which is standard deviation, is given. Okay. 5 years. So you have been given from 3 to 7. That is 5 years only. Year 3, year 4, year 5, year 6, year 7. So 5 years. Okay. Now you are required to do the calculation. Just a minute. Okay. So now we are going to use a free cash flow to value the firm. You know that there are so many ways of valuing a firm: cash flow, income based, and asset based, market based. Okay. So Cash base, this is a cash base, and free cash flow to firm is one method. They have already told which method to use. Okay. Sometimes they just tell you estimate the current value. You have to decide what is the method based on the information you are given. So the good thing is here they have already told you. Usually the good thing is when they are giving so much requirement and it is for less marks, they specifically tell you which direction to go, which method to use. That is one good thing. But when the requirements, if it's just as part A and B and requirements is less but marks is big, in that time then it's a little issue. Then there's a problem. You have to decide what method to use. But here they have specifically told, so you don't have to worry about it. Now let us go to party. If you see here the report, the format which I have been telling you, to, from, date, subject. Okay. So now, what is the subject? Impact of the takeover proposal from Miji and the following on project. It is not just the impact of the takeover, but also the follow-on project. Two things are there. You need to write it. And to whom you are writing? To the board of directors of Nente. From whom? An accountant. You could be an accountant. You could be anything. Financial advisor, consultant. You can write anything. And date. Write that if they don't specify a date. Usually they will not give you a date. So you have to write a date. The day you receive your exam paper. That date. The date of your exam you can write as date. Okay. Now, what are you going to write in the report introduction? Now I think I don't have to keep on repeating the same thing. I can go quickly because I've been doing this. That how you have to start a report, what have to be there, and also all those I have said before. Now I can quickly go. So this report considers the value to both Nente and major shareholders based on a cash offer and also on a share for share offer. Okay, two offer. Okay, value to this and this. It discusses the potential reaction of these groups of shareholders. Yes, you have to discuss the reactions of these groups of shareholders also to the alternative offers and how best to make use of the follow-on opportunity. All significant assumptions made in the assessment are also explained. So the appendices to this report show the detailed calculations. Now this you can write also. If you don't want, you can leave it also. It's your choice. Because anyway you're writing appendix and you are writing a section in the report, whatever the calculation you have done. For estimating an equity value for Nente and value to shareholders of Nente and value of the acquisition under both the cash offer and share for share exchange and the value of the follow-on product raised to Nente. So there are three things you are doing here. The result of the detailed calculations are shown here. Okay. So if you see here, just brief the main numbers you are giving. What is the value under share for share offer for each, and for cash offer, what is the value? Share for share offer, what is the percentage gain? But it is in appendix. So first we have to go to the appendix. This you will not understand. Keep space. Okay, so directly we are going to the appendix. Appendix 1. Of course, it is the estimate of the current value of Nente's equity based on free cash flow. Make sure that you know the formula for free cash flow. Okay, so the total value. Memorize this formula. If you don't know, it is free cash flow into 1 plus growth rate divided by cost of capital minus G. Okay. Now, here it is not easy. It is not an easy thing. Why? Tell me why. You have to find each component. You have to find the free cash flow. You have to find the growth rate. It's not given. You have been only told that from the current growth rate, it will reduce by 25%. But do you know the current growth rate? You don't know. That also you have to work out. And cost of capital, of course, it is given to right? Cost of capital is 11%. That's what they have wrote here. K is 11. Whatever is written, you write. Whatever is not there, you have to find out. So you have to find out two things: free cash flow and growth rate. Okay. First, it does not matter what you start first, provided it is not. You can start in any order. Okay. You can start first finding the growth rate also, or the free cash flow. You can start with the free cash flow also. Here they have started with growth rate. Okay. To find the future growth rate, first you have to find the past growth rate. So what is the past growth rate? That is your number one. This is why I always write the formula first. Because the formula, then you know what you have to find out. Like through the formula, now I know I have to find free cash flow, I have to find the growth rate. So past growth rate. Okay, past growth rate means how? Latest profit. I've told you latest divided by the earliest. profit before interest and tax. To the power 1, number of periods of growth minus 1. Okay. So all this figure, we have to go back. Okay. Just if you see here, profit before interest and tax, it is 1 to 30. This one. Okay. Oldest. And then Nente's profit before interest and tax in his first year of operation were this one, 970,000. Okay. So 970 and 1 to 30. 970 is the earliest and 1 to 30 is the latest profit. Okay. To the power 1 over 3. Now why it is 3? Why is it 3? And have been growing steadily in each of the following 3 years. Each of the following 3 years. That's why. And minus 1. So this is the growth rate. Okay. And what is the future growth rate? 25% of that. This one. Okay, we'll see why 25% is that. Because somewhere we have been told. Okay. Here. So the growth rate will reduce to 25% of the original rate. Will reduce to 25% of the original rate. They didn't tell it will reduce by 25%. They told it will reduce to 25%. So this 2 and this by, if it's in front of a number, before the a number, it makes a lot of difference. You have to see whether it's to 25% or by 25%. If it was by 25%, it would have been 75%. But this is to 25%. So it will be 25% of that past G, which is this. Now, next is free cash flow calculation. So you had done the growth rate to find the total value. Now you need the free cash flow. Free cash flow you have to adjust. You have to adjust. Free cash flow also you have to write the formula. This is the formula. If you don't know, memorize it from here. Profit before interest and tax plus non-cash flows minus cash investment minus tax. All your non-cash flow items, whichever you have deducted to get that profit before interest and tax now needs to be added back. It's like we're adding back your depreciation and all those things. What is your profit before interest and tax? It is this from your income statement. Then you have to add your non-cash flows. Okay, when you are adding your non-cash flows, 1206, here you have to be a little careful. They have told the tax allowable depreciation, they have deducted which and non-cash expenses totaling 1206. So this needs to be added back. Okay, and annual cash investment is this. This is your annual cash investment. 1010. So you are adding your non-cash flows and deducting your cash investment. Obviously, additionally non-current assets, cash investment you have to deduct. Minus, if you see, what is this you are minusing? What is this component part? Why 20%? Tax. You have to deduct tax because on that you have to pay tax. You don't have to pay tax on the total after adding non-cash flows and cash investment. You have to take tax on profit before interest and tax on this amount. Profit before interest and tax only you are paying 20% tax. Tax is 20%. So on that you have to pay tax and that has to be deducted. So now your free cash flow is this. Now you have all the component. You have the growth rate, you have the free cash flow. What's next? Just put it in the formula. So free cash flow. Okay, look at this formula. When I'm telling here the total value, free cash flow into 1 plus growth rate. So 1 growth rate is 0.026. So 1.026 divided by cost of capital is 11%. And this the growth rate. So this is the value, but it is the total value. What do you want? What do you want? Equity. Equity value. For that, what do you have to do? You have the total value. What do you have to do? Deduct your debt. Deduct your debt. 6.5 million. Let's see. How will you get that debt? Balance sheet. Statement of financial position. This one. Non-current liabilities. You have to deduct. Always total value divided by your non-current liabilities will give you the equity value. So don't forget to deduct that uh, debt. Most of you forget. You stop at this point. But my dear friends, this is equity value, total value, and 99% of the time, equity value, they will ask equity value only rather than the total value. Then number of share. So what is the number of share? Because you have to find equity value per share. For that you need number of share, because now you have the equity value. You need the number of share also. Number of share is 960 divided by 0.2. Again, you have to go to your this thing, right? It is simply 960 divided by 0.4. 40 cents per value share. You will get. Okay, that's what they have shown here. 960. Okay, here, and this is your number of shares. So equity value divided by number of share, you are getting this 2.9. I'm putting it in square so that you know this is an answer. Equity value per share. Now come to appendix 2, cash offer. Okay, before going to cash offer, appendix 2, check your requirements. Check, are you in line with the requirements? You always have to keep checking with your requirements. Remember that. In long page of information, you forget what you have done. Estimate the current value share using the free cash flow to firm. First thing you have done. You have done, finished. Second, estimate the percentage gain in value to enter share and major share under each payment offer. That means under both cash offer and share for share, for both Nente and share, you have to find the percentage gain. That's what we are doing. We are in the second requirement now, which is under appendix 2. Okay, and appendix 2, you have to clearly mention cash offer, share for share offer, and both for two shareholders this time. Okay, which shareholders you find for first, it's your choice. You can find in any order. That does not matter. So they are starting with the Nente company. That is the company which is going to acquire. So gain in value to Nente company shareholder. Okay, they're starting with Nente because previously we have found the equity value per share of Nente company. Okay, Nente. So how are they getting it? How are they getting it? Gain in value. What is the equity value per share? See here, 2.9, and it is 2.9. What is 2.95? Look at the offer. Go to the cash offer and see. The cash offer is what? In proposal 1, it is 2.95 cash per share. 2.95. That's why it is 2.95 minus that 2 point what you have got equity value per share. Can you see you have calculated something for something else in the first requirement? Now that you need in your requirement 2 also. Okay, divided by 2.9 because you want to find in terms of percentage gain. That's why. Otherwise, you could just take 2.95 minus 2.9. That's your gain. But as a percentage, if you have to find out, 2.95 minus 2.9 divided by 2.9. 1.7%. Keep it in percentage. But when you're coming for the target company, Miji company, right? Can you find the gain to value for the major company straightly like that? Just see the number of working here. 1, 2, 3, 4, 5, 6. How many steps are there to get to the value of major companies, and then only finally you are finding gain in value to the shareholder. Okay, to find the gain in value to the shareholder, do we know the value of the major company, the equity? We don't know. Then start. How are we going to start? Not free cash flow, not like how we have done for Nente company. Here We are given the price PE. We are given the PE. So what we have to do using PE, price over earning. Divide this into the formula price over earning. We have to find the price. We have to find the earnings. Earnings, where, how do you start earnings? Post acquisition. Post acquisition earnings you have to find. Then we have to find EPS. Okay, so that's why they are starting with additional earnings post acquisition. What is that additional earnings? If you can see, it is 620 plus 150. What is the earnings of major company? Okay, 150 is their synergy. Okay, that is the synergy. We have marked it somewhere. It's up. Yes, this 150,000 is the synergy. And how are we getting it? We have not been given here. This after acquisition 620 profit after tax plus that synergy, because we want additional earnings after acquisition. So it is 6, if you see here, 620 plus 150,000 780. Next is additional EPS. We now found earnings. From earnings we can find EPS also, because we know the share number of share. We know we want earnings. Once we get the earnings, now we find EPS. What is EPS? This earnings divided by number of share. What is number of share? 10 million. We'll go and check the share. Okay, the share is 10 million. Here they have 10 million shares in issue at trading at 4.8, but we want the number of shares, so 10 million shares. Right, so divided by 10, this is your EPS. Once you get your EPS, can you find your PE ratio? Because you have to find PE ratio of Nente to find their value. That's how you're finding the value, using a market-based method. Market-based means PE ratio. That's why we started with earnings, then EPS to get the PE ratio. Okay, because your this one will increase, right? Using the P ratio to calculate the increase in share price. You need to know the share price, because number of shares into the share price only you will get the total value. Okay, so what is the PE ratio? We have told that PE ratio is 15 into EPS. That will give you share price, right? If you're not understanding this here, price over earnings, that is PE ratio. Earnings per share into earnings per share. Earnings per share means earnings over share. So EE gets cancelled, you are left with PS, price per share, that or in short share price. So for you to get the share price, you multiply PE into EPS. So this is your EPS and this is your increase in share price. Now additional value created. What is that additional value created after acquisition? Number of share is 10 million. Share price is this. So this is your equity. From here, less cost of acquisition. Additional value created, there is some cost of acquisition also. What is that cost of acquisition? It is 2.95 per share. So 2.95 per share, how many share? 2.4 million share. Why 2.4 million share? Why not 10 million share? Because look at this, 2.95 per share. Okay, whose share you want to acquire? This. 960 divided by 0.4, which is 2.4 million, right? Nente companies. So it is into 2.4 Nente companies share into this. And now value added for major company shareholder. What is the value added? What is the additional value created minus the cost? This one. Out of this, what is the gain in value to a shareholder? They have number of 10 million shares out of this. So this one. Now the gain you can calculate. 45.2 divided by 480 cents. 9.4%. How are they getting 480 cents? How are they getting this 480 cents? Ten million shares trading at 4.8. So 10 into 4.8 is 480. It is dollar. You have to make it in cents. Right? If you make 4.8 into cents, how much it will be? 480 cents multiplied by 100. So for 80 cents, you have to take it in cents. You cannot take it in dollar because this one is also in cents. So that's why you're dividing it by 480 cents. 4.8 you're converting into cents. So 45.2 divided by 480. The gain over the price of the share. What is that gain in percentage? 9.4%. It is higher, right? Here they are only having 1.7%. I'm keeping in the box whatever you have been told in the requirement to do. The main answer. Now coming for share offer. Okay. Mark my each word and see how I'm proceeding from next step to next step. Okay. Final answer does not matter. Don't always see whether I'm getting the final answer somehow or not. In between the steps I'm following matters a lot. Okay. So earnings of a combined company. You have to find the combined company's value by them. Okay. Because this is for share offer or even for cash offer also. You have to find the combined company. This is the accusation. In accusation, first you have to find the combined company's value. Then only you can find the value for the Nente and the major company separately. So what is the combined company value? 770 from above plus 3.2. As you can see here, 770,000. Additional earnings post accusation is 770,000 from, right? Plus 3.2. What is this? What is it? How did you get this? This is the earnings of what? Combined company. So 770,000 is 620 plus the synergy, and this 3 million 3.2 million. How does it come? Major's current profit after tax is this. So you're adding both. Okay, now number of shares in combined company. What is the total number of shares in combined? One, it's the share for share of. This step is necessary. Total number of shares in a combined company. So 10 million we have of Meiji and 2.4 of Nente. This fraction. This fraction is the problem. How do you decide? Okay. Let's go for share offer and see. Two Meiji for 3 Nente shares. That means what? You need to divide it by 3 because how many shares? 2.4. This is M. This is N. 10 million. Okay. They have. Now this 10 million plus 2.4 of Nente, but out of this 2 of M, sorry, this is the other way around, Nt, and this is M. I'm sorry. 2 shares of Nt, 2 shares of M for every 3 shares of N. That means you need to divide this by 3. For every 3 shares in N, you are getting 2 shares of M. So it is into 2 divided by 3. Okay, this is how you're getting it. Next, EPS of combined company. You have the earnings, you have the number of shares. It is easy. Just that divide by this, you are getting EPS. It is C. Okay, make sure that you write the correct this thing. You must be writing dollar, then it will be wrong. Expected share price using PE ratio. What is the expected share price using PE ratio? Your PE ratio is 15. Multiply by 34.2. That is your EPS. So this will be your share price. 530 cents or $5.13. Now, gain in value to shareholder of Menje. What is the gain? This is your share price. Minus 4.8. Why 4.8? How is it 4.8? Because the share price in Menje is how much? $4.8. So 5.13 minus 4.8. Here, go up and see here. We took it as cents. So 4.8 we multiplied by 100 to get 480. So it was $4.8. Right? This is also dollar. This is also dollar. Deduct divide by 480 and this is your gain. And what is the current value of 3 shares in Nent? Because you cannot find the gain in value to the shareholder of Nente company. The one is going to acquire. First you have to find what is the current value of the 3 shares. Okay, then only you can find the value, because Nente is giving for 3 of their share, they are getting 2 of Mijay's share. So they need to evaluate what is the current value, right? So here we can say it is $2.9 into 3. How is it $2.9? Here, you have to go up in your appendix 1 and see your equity value per share in this thing is 2.9, right? It's current equity value. So you don't have to do that step again. So it is 2.9 into 3. For 3 shares, it will be 2.3 into 8.7. Because for every 3 shares in Nente, that's why you have to value those 3 shares with the current share price. Now you can find the gain in value. 25.3 minus by 8.7, because 2 of the M share you are taking. So what is the value? Expected share price for M, it is 5.3. So 5.3 into 2 shares, because 2 shares you are taking of M, minus the 3 shares which are valued in N is this. So this minus this divided by this. This is your gain. I'm not sure how much you are able to catch up with this or understand this, but if you haven't, do let me know in the comments below. I will respond to you, right? Appendix 3. Now Appendix 3. Now go to your requirements again before I go to Appendix 3, so that we didn't miss out on anything. Second also we did the second one also. We estimated the percentage gain in value to Nente and Mendes shares under each payment of both the payment offer. Now coming to the third one. Percentage gain in the value of follow-on projects. So Appendix 3, that is Appendix 3. So coming to this Appendix 3. Okay, we just have one more. This is the last appendix. Value of the follow-on product. Okay. So for that, you have to take your present value of cash inflows, deduct your cost, and net present value of the new product. You have to get what are the present value of the inflow? 2434. 2434, yeah. So this is your investment, 2500, and this is your present value, 2434. Right? 2434 is the cash flow, but this one is not 2500. It's the present value of the option cost, 2029. This one. This is a cost, right? So, and you have to find the present value of that cost. So 2029. And find the net present value. Because both are present value, so you can find the net present value of the new product. It is this, it's a positive. So now you have to make that one statement that it is positive and it will increase the shareholder value. Who is the shareholder? Nente company. Without taking the value of the project, value of the option. So based on net present value, without considering the option to delay, the project would increase the value of Nente. Value of whom? Nente company. By how much? By the amount of the present value. Now the value of the option to delay. Separately you have to find out. Understood? First you have to find the net present value. Then you have to start with the value of an option to delay. For this you have to use this model. This is how a 50 marks question is tested. It is not an acquisition and merger. It will also include other is, like in this case regal option is there. Anything can come with anything. So what is the value of an option to delay, right? What is the price of an asset? It is simply your present value of future positive cash flow from here, this one. Now exercise price. What is the exercise price? Initial cost minus not discounted. Okay, it is not discounted. Initial cost. What is the initial cost? It is this exercise price. Time to expiry of the option 2 years. They have told. Yes. Risk-free rate 7% minus 380 basis point. That means 7.8 minus 3.8. So 3.2%. Volatility 42% they have got. Now you have all the 5 variables. Just put it in the formula and get it. So D1 PA over PE plus risk-free rate plus 0.5 into standard deviation squared into time divided by standard deviation into time to the power of 0.5 means 1 over 2 for 2 years, right? 1 over number of year. So this is your D1, and D2 is D1 minus standard deviation into time to the power 1 over the time, which is 1 over 2. So you are getting a minus figure here. Okay, be very careful when you are getting minus figure and a positive figure. It is different. So n, and you have to keep it into 2 decimal places, by the way. Let's say if D1 you are getting 0.359, you have to find for 0.36, like here. Here it is 3, but you have to keep it into 2 decimal places. The reason you have to use 2 decimal places is when you use a standard normal distribution table, you only find for 2 decimal places. So make sure you know how to find the values from there. Okay, so if it's a positive number, the amount which you are getting, it will be in 4 decimal places only. Add 0.5 with that, like this. If it's a negative number, from 0.5, the amount you have to deduct, which is here you have to minus. That is the difference. Now the value of an option. ND1, sorry, your PA into ND1 minus your PE, which is exercise price, into ND2 into this portion. This portion is from the formula only, e to the power minus, what is it? R into times. And from here, okay, so this is from this portion, and this one is from this portion. Do it separately if you cannot do it in one go. I would even recommend to do it separately. There you have less chance of getting wrong mistakes. If you are trying to do it in one length, one go, you might make mistakes. Okay, always check twice. You are doing in the calculator, check twice, because you will not get that time to check again in the end of the paper. Now what happens? You can see, look at your present value 405. This is having 609. So the value is increasing or not? It is increasing. This project increases the value of the company by how much? By this much. Or this one you have to find as a percentage. How did you get the 25.4? This simply this. The amount 609021 divided by 2.4 million number of share. Okay. So in percentage time, this is an increase of about how much? In terms of percentage, it is 8.8%. You have to find this percentage. Let me put it in box. Okay, 25.4 divided by 290 cents. Okay, this is cents. It might be $2.9, but don't go and write 25.4 divided by 2.9, because 25.4 is in cents, 2.9 is in dollar. So you have to convert into cents first. Cents, you can divide cents by cents only, not cents by dollar. Check that also. Okay, so 25.4 divided by 290. Because we have got 290. From where? Go up and check this one. It is 290 cents if you convert $2.9. Every time you don't have to do the calculation. So now you're done. Now let's write and fill up the report. Okay, so go to your requirement again and see you're done with this part also. Now fourth part is you have to discuss that. You can write in the report. So here let's see. So results of the detailed calculation. Estimated the current price of this one. This is an estimated price in appendix 1. Okay, now estimated increase in share price. It increased by this much. We found all these percentages. Just put it here. This is an estimated value per share on the following project. This one line you have to write. One thing, be very careful. Just because you have wrote some number or you have wrote in your appendix does not mean that you should not write in a report. You will not get marks even if you have put in your appendix, but you are not writing in the report. That one line sentence you have to write, because the requirement specifically asked what is the estimated value per share of the follow-on project. As a percentage you have to give. All the figures are in percentage. Okay, percentage. Even this is percentage, the 8.7%, and name the appendix 3. Now, looking at the figure, just write discuss. Now you are in the fourth requirement. So the cash offer is unlikely to be accepted. It is in bold. Of course, just see only 1.7 for Nente, but for major the majority is going. Majority percentage is going to major. Major is the target company. So why would Nente want to acquire major if they are not getting the offer gain? Percentage gain maximum is going to the target company. So cash offer is unlikely to be accepted by Nente shareholders because the estimated gains are only slightly higher than the current share price. Okay. Although being unlisted. Who is unlisted? Nente is unlisted. Shareholders may not be able to realize the current price should they wish to sell. Yes. They cannot realize the current price because unlisted. So the share for share exchange gives a much larger increase of 17.9%, linking this, and is much more likely to be acceptable to the shareholders. It is also higher. See, it is in bold. You have to write it like this, like a probability terms. You have to write highly likely, unlikely, most probable, like this. It is also higher than expected return from the follow-on product. Yes, follow-on product is just 8.7%. The 17.9% is even higher than that. And therefore, based on the financial data, the most attractive option for Nente shareholders is the takeover on a share for share. Based on, if you are saying something that you have to go for this, you have to say that based on this decision or based on this data. So this is based on what data? Financial data calculations, right? Attractive option is what? Nente shareholder is the takeover is on a share for share exchange. You have to write all this in your report. Most attractive 17.9% is higher than the follow-on product, which is 8.7%, and also cash offer. That is for Nente. We have to discuss for all the shareholders. Remember, all stakeholders. Now we have to talk about major shareholders in a different paragraph. So major shareholders are likely to prefer the cash offer, if you see, for Nente, because 9.84% higher than share for share, right? So they are going to go for cash offer so that they can maximize their own returns and do not dilute their control of the company. Key point, when you go for cash offer, what happens? There is no dilution of control of the company because you are not losing any shares. You don't have to give any shares. You are retaining their shares. You are only giving cash, right? You are receiving cash and that's it. But they may accept the share for share offer as, see, they may, I'm telling you, always write in your probability terms. They may, unlikely, highly likely, most probably. This way you have to write your answer, okay? They may accept the share for share, okay? It's not bad. Still, it is high, 6.9%. That's why they didn't say. See how they are building up the answer. They didn't tell, okay, only cash offer they will accept and share for share. No, they are saying they may accept the share offer also. As this still offers an increase in value, yes, still it increases an increase in value. Major shareholders will need to consider whether these returns are in excess of any other investment opportunities and that are available and whether the acquisition of Nente is the best use of funds. Yes. There are a number of assumptions present in the calculations. Now you're talking about assumptions specifically stated in the fourth requirement. For example, now you are listing all the assumptions. By calculating the current value of Nente share for the free cash flow in model is used. Whenever some model is used, please specify that model in assumption because all the models in AFM are based on some assumptions and some estimations. Some limitations are there. This is your highest area where you can score maximum marks. I would say you can even score full marks given for assumptions. If you know the right way of listing your assumptions. First, starting with the first one, go in order. Don't jumble up. You will forget what you have included or not. Everything systematic order. Start from first to beginning. First requirement, you used free cash flow model. That itself is an assumption. Why? Growth rate you assumed. Right? This assumes that the growth rate number one. And the free cash flow exists in another assumption. And the estimated cost, third assumption. is appropriate. So see, under one model, how many assumptions are there? Already three assumptions you gave: growth rate, cash flow in perpetuity, and the estimated cost of capital. All these are estimates. Coming to the takeover part. The takeover offer analysis is based on the assumption that the proposed synergy savings will be made. Another is synergy savings. We don't know synergy. We don't know whether synergy will be there or not until the acquisition goes ahead. But we are estimating before the acquisition, should we go or not. So it's an estimate. Will be achieved, and that the PE bootstrapping approach is valid. What is PE bootstrapping? You are increasing the PE. But make sure it is an unlisted company. Right? So for unlisted company, PE ratio will not be there. For the calculation of the follow-on product, now you see the systematic order. Can you see? Slowly they are going. They are starting from the first, then they are going to the takeover. Now they are going to the follow-on product, which was your third appendix, third requirement. So for the calculation of the follow-on product value, third model, what is the model you used? Black-Scholes option pricing model. This model is itself is built on 5 or 6 assumptions. So what is it? List. This is a great area for you to jump and score the marks. I would be very happy if I get this kind of paper. So for the calculation of follow-on product value, the option variables are estimates. And an assumption is made that this will not change. Yes, assumption is made that those variables will not change, like standard deviation, interest rates, and all. Period before the decision is taken. The calculated value is based on the scenario that the option can only be exercised after 2 years. Another assumption that it can only be exercised after 2 years. It's an assumption, right? But it appears that the option can be exercised at any time within the 2-year period. You can exercise in 1 year also, 1.5 years, not exactly in 2 years you will exercise, no? Now coming to the next one. Try to put some figure or something. So the follow-on product has been treated separately from the takeover. But Nente could ask Nente to take this into account in its takeover offer, yes. The value of the rights to Nente is this one. What is the value of the right? This. And adds around this one to the value of Nente company's share. If measure were to increase its offer by this value, or the rights could be sold prior to the takeover, then the return to Nente would be this one. Right? If you're increasing that also with that. So then the return to Nente would be this much. Now in conclusion, can you see? Writing conclusion. Very small, just 4 lines. So in conclusion, what is it? The preferred outcome for Nente would be to accept for share offer. Okay, keep it simple. Share for Nente. And to convince Meiji, you have to convince Meiji to take the value of the follow-on product into consideration, because it will increase the Nente company's return. So Nente company shareholder will need to be assured of the accuracy of the, it's in bold. I'm not underlining it. You understood the importance of it. They will need to be assured of the accuracy of the calculations provided in the appendices before they accept the offer. You always have to talk about your assumptions in the calculations, conclusions. That they have to take these assumptions in the account, and they have to see whether they are accurate or not, and then take a final decision. This is how you should end your conclusion. So we are done with part A. Now can we see the marking scheme of only part A? Right? So appendix 1, appendix 2, appendix 3. Right? Based on this one, calculation of growth rate 2 marks, calculation of free cash flow 2 marks, company value, equity value, and value of each share 3 marks. 1 mark for this, 1 mark for this, 1 mark for this. Of course, first you have to find the company value, then only you can find the equity value, then only you can find the value of each share. So it should go that order. Coming to 2. Okay, cash offer. If it's cash offer, estimate of value of combined company. 3 marks. Because finding the combined company is not easy. There are so many steps required. Value created per share for Nente company shareholder, 1 mark only. Now coming to share for share. Again, expected share price. You have to find out, because it's share for share. For the combined company, 2 marks. Value for Nente is 1 and Measure is 1. Coming to appendix 3. Value of the underlying asset, 1 mark. Value of the underlying exercise price, ND1, ND2, it is 2 marks here. Value of a call, it's a call option. Another very good thing which I forgot to tell you. Call or put, it's a call option. Because for put, there's another separate thing. One more additional calculation is there. But thank God this is a call option, because it's an option to delay. You have to know option to delay Option to expand, these are call options. Option to abandon, option to redeploy, these are put options. And value added to Nente shares, 1 mark. Next, discussion. For Bento shareholders, 2 to 3 marks, 1 to 2 marks for Bento shareholders. Assumptions made, 2 to 3 marks. User value of this one, 2 to 3 marks. And rest is professional marks. Equal it is divided into each, if you see. Now coming to part B and C. Okay. So coming to part B, what was B asked? What was part B asked about? It is for 8 marks. Current performance of Nente and comment on what this means for the proposed takeover bid. You have to evaluate. You can even use some of your part A to do that, 8 marks. So 2 marks for each, right? Performance. Performance means operating profit. You have to start with operating profit first. So Nente has an operating profit margin. Ratios. One good thing, thank God this question came up, that this is the right time for me to tell you. What is this? Whenever this question comes, current performance ratios, you have to do ratios and comment. That's what they are doing here. For this, you don't have to do appendix because this does not come in report. There itself, you can do the calculation. So Nente has an operating profit margin of 14%. How did they get this? This is your profit, this is your sales, 870. But significant interest payments mean that the profit after tax is approximately half of this one figure. This profit after tax figure is less than the required annual investment in non-current assets and working capital. Okay. It is less than the required annual investment in non-current assets and working capital. Before going to the next one, we'll see here this operating profit margin. Yes. Yes. So it is 120 divided by sales revenue. This divided by this. And when you take the interest also, when you see the profit after tax, it is just 620. It is just 620 here. But when you go for the investment and all, right? Did they tell here? Okay, 2.5. Yes, non-cash expenses totaling is 1206. It's much than that profit after tax. So sorry, I'm sorry, this one. This annual cash investment and working capital 101. It is much higher than profit after tax. Right? Now we are going to the financial gearing. This is also performance. You can talk about interest and all. So Nente has a high level of financial gearing. How are we saying this? When measured by book value, the gearing level is 73%. Wow. Because you're what? You have to find your interest. Right? 6.5. Just this is your long-term liability from your balance sheet, and 2360 is your interest. We'll go there and show. Just sec. I have circled also. Non-current liability 6.5. And your interest. Okay. So interest is 455, current liability is 1890. If you add, it will be 2360. It is 2360. 2360 have to be your equity. We'll go and check the balance sheet. 2360 has to be your equity. Yes. Add your reserves and share capital. It will be 2360. So your debt and debt divided by debt plus equity. That is your financial gearing. Okay. Measured by book value. This high level of debt coupled with rising interest rates. Okay, so interest rate rising and high level of debt means what? Interest payments are high and interest coverage is currently 2.7 times. Interest coverage. How did we get the interest coverage? Profit after tax was what? Interest and tax 1230. Sorry, 1230 divide by divide by your interest is 455, which is 2.7. Okay. Okay. So now coming to this, the third. Given that the future growth levels are expected to be 2%. Okay, from part A above. Can we go to part A? What was it? It was this, right? So if you take it, it will be 2.06% only. 2% only if you round up the growth rate. So given that the future growth levels are only expected to be 2%, profit after tax is unlikely to increase significantly unless interest rates fall dramatically. Yes. The low level of profit after tax means that no revenue has been paid in the most recent period. Of course, if you're having low profit, then you will not pay a high dividend, right? So, and the business angels will want to see a return on their investment, which is unlikely to be in the form of future dividend given this prospects. Therefore, they are likely to be attracted by prospects of an exit route, you are saying, through a sale of their equity stake. Business angel. Who are business angels? They are the one who have they are large in cash, huge amount of cash to invest. Wealthy individuals. Okay, we have been told about those business angels in the beginning itself, right? They why they want to exit? Because if they see they are not getting any return, they are not going to get a dividend, then what's the use of them? Right? So they are more likely to be attracted to exit that company. They have the power, they keep on exiting. How are they going to exit? By selling the equity stake. They have 80% of equity stake, by the way. It's going to have a huge impact on their performance from the beginning, if you see. Just see. 5 business angels, 80%. They hold 80%. Now, the next one. So, the follow on product should help to increase their growth rate. But with the limited scope for expansion and lack of other product development, the business angels will need to sell the equity stake to generate significant returns. Now, can we go and seek the marking scheme for it? For part B before we move to part C? These are the 4 marks. 2 marks for each. Profit level discussion, financial gearing, growth rates and dividends, impact on follow-on product. All this will have an impact. Now, for part C, it is 1 to 2 marks. For each defense covered, max is 7 marks. We have to talk about the defensive strategies. Part C. There are a number of possible post-bid defense available to meet you. What are they? Attempting to have a bid referred to the competition authorities. Seems unlikely to be successful. Okay, see, attempt to have the bid referred to competition authorities is unlikely to be successful based on the size of major company. And because this is a vertical merger rather than a horizontal one. Which means that this is unlikely to significantly increase its existing marketing share. Okay, before coming here, let me again refresh my mind and yours too. So we have read everything. Okay, so the third one is since the approach, so this is a small case study relating to part C only. Since the approach to Nente Meiji itself has been the subject to take over from 10 listed company, which specializes in supplying machinery to the manufacturing sector. Okay, this is vertical integration they are saying, not a horizontal, not in the same line of business. That means either backward or forward. How are they saying it? They are supplying. Okay, TNA is supplying machinery to the manufacturing sector. Which line is in major is in? They design and develop. They're the manufacturing sector. Okay. They are in that sector, manufacturing sector. That's why they are saying it's a vertical integration, not a horizontal one, and has a market capitalization of 245. You have to use this. So evaluate the general post-bid defense and command the suitability for major to try to prevent the takeover. So you have to tell how suitable the post-bid defenses are for major company if they want to defend themselves from the takeover from TN. So 1, 2, 3, 4, 5. Here I can say 5 strategies they have given. Here they are saying it's a vertical integrated merger, and so it is unlikely significant increase unlikely to significantly increases existing market share. Yes, it cannot increase its market share by going like this because there's a vertical margin. Now, so they have talked about 5. This is 1, this is 2, this is 3, this is 4, and this is 5. You have to say how suitable it is, whether it will be suitable or not for major company to use this method to defend themselves from the takeover from the company, TNA company. If it is specifically the TNA takeover that major wishes to defend against, then a white knight defense would be a successful tactic. They are saying white knight is a successful tactic. Make sure what is white knight. This involves finding a friendly company. You have to define what is white knight. This involves finding a friendly company to join in the bidding process and eventually acquire major. So you are telling your friend to come and acquire you, okay, so that you don't have to be, you will not be taken over by another company which is not so friendly to you. That's called rescuing. Your friend is coming and rescuing you there. It is told as white knight. So they are saying in this it will be more successful. The difficulty will be in finding a willing friendly company. Yes, to find that the friend who is willing to do that is difficult. Second, come to a counter bit, and this is also a key question which can be asked in your accusation merger question, a theory question. So learn this. A counter bit does not seem to be appropriate. Counter bit does not seem to be appropriate. Given the relative market capitalization of major compared to 10A, what is the market capitalization? Now use it. That's where that market capitalization is given. So Train A has a current market value of 240 in the case study they have given, whereas it is over 5 times the current market capitalization of major 48 million. Right? Over 5 times, even more than 5 times. Counter bid means what? You go and try to take over. You announce that you are going to take over that company before they take you over. In this case, it is not possible. It's very highly unlikely because look at the market capitalization. The company is so huge compared to the major company. 48 million is their market capitalization. Right? We'll see. So we'll go up and see. Yes, it is 10 million and share price was 4.8. So it is 48 million. Yes, yes. Now coming to the third one, crown jewel. Defense wood. What is crown jewel? Defense wood involves selling of Media's most valuable assets to make it less attractive as an accusation. You are selling the most valuable asset so that you become less attractive. Because why do a company want to take you over? Maybe for your goodwill, you are having your brand, your reputation, you are having, or most valuable assets. Okay, if those valuable assets are not there in the first place, why would a company take you over? You become unattractive for them. Okay, so this may mean that TN is uninterested in continuing the takeover bid, but it would compromise their current operations. Yes. You also have to give a drawback of it. There's a drawback also if you're selling your most valuable assets. It would compromise the major's current operation, and as such, existing shareholders may object to this. Yes. Existing shareholders may not be happy with this arrangement. You selling valuable assets. Poison pill. What is poison pill? Defense attempts to make a company unattractive. Same like crown jewels. It wants to make a company unattractive, but the way is different. Normally, by giving the right to existing shareholders to buy shares at a very low price. You are saying them. Yes. This could be used by major, but the existing shareholders need to be willing to put additional funds into the business. Yes. This could be used. I'm told you always answer in a probability terms. Could be, maybe, perhaps, most likely, most unlikely. but never sure. Okay, you're never 100% sure of what you're using. This could be used, but shareholder, they have to be willing to do it. Okay, so the shareholders are unlikely to do this if the takeover is actually in their best interest. Yes, if the takeover is actually going to benefit you, then why you want to defend yourself from that takeover? Shareholders will not do this at that time. It's hard to believe. Finally, the last one is a golden parachute. What is it? A golden parachute involves offering large benefits to key management personnel who would lose their position in the event of a takeover. Yes, you have to offer large benefits to those who are going to lose their position in the takeover. Offering those large benefit, large remuneration to those key managers, it's very expensive, very, very expensive. So this would then make the takeover more expensive for Tene and acts as a deterrent. This could be a good option for Media to take to defend against this takeover. Yes, this could be a good option. Could be. Right? So that's it for this. Now, and if you see the marking scheme, 1 to 2 marks for each defense covered, and it's for 7 marks. Now let us go through this. Here, what did we cover? We covered accusation, we covered performance measurement, and we covered the defensive techniques in a takeover. Top tips. So these are the 3 areas we covered: accusation, defense techniques, and performance measurement. Top tips. In part A, do all the calculations first as appendices and then write the report based on these calculations. Make sure you have read all the information in the scenario. Spotting the risk-free rate is difficult, but you are told 7% is 380 basis point over the government base rate. So you can assume the risk-free rate is 3.2%. Okay, the 7% is over the 380. Okay, which is 7% is 380 basis point over the government base rate. So that risk-free rate you have to assume is 3.2%. It will be less, of course, it will be less. It is not that you have to add, okay, 3.8. You have to deduct 3.8% from the 7% to get the risk-free rate. In part B, you should perform a couple of easy calculations to show financial performance. Yes. And comment on this, what it means for Nente. You have to comment also. Easy marks is part C of some relatively straightforward marks. Yes. Examining team comments. Answers which give a report a title but then did not structure the answer properly gain few professional marks. Yes. Just giving a report a title does not matter if the structure and everything is not correct. Now, in part I was relatively done adequately. Okay, was done. Generally done adequately. A significant number of candidates calculated the growth rate almost, although some misread the question and read the growth rate information as by 25%. By instead of it is to 25%, not by 25%. So if you misread that, in a number of responses when calculating a free cash flow to form, errors were made such as including interest and when calculating tax impact. You should not include interest. Okay. You have to take free profit before interest and tax. Free cash flow to form. Many candidates did not deduct the debt from the free cash flow to get the total value per share to deduct. Some candidates did not divide. You did not divide the total value by number of shares to get a share price. A significant number of candidates had difficulty with second part, and especially that is your using cash offer and share offer, that one. Especially with obtaining a value for the combined company. You struggle to find a value for the combined company based on the combined company's earnings, which includes synergies and a modified PE ratio. This is fairly standard method of obtaining the value of the combined company, and it was expected that most candidates should have been able to do these computations at AFM level. Yes, you should be able to handle this type of questions in AFM level at this stage. Okay. Before I conclude this video, this was my last video on revision kit. We have done successfully. We have finished all the revision kit questions. Yahoo! So here's to us. I think I have some mocks to cover and also September 2020 paper. First question that is left. And after that, I am taking a break after the mocks and that 2020 paper, the first question. After that, I will only be making videos if I get any response or any comments from you to make a certain video on certain questions. Then only I'll be making a video. Otherwise, I'm taking a break because I want to give you a break of 1 week for you to practice on your own and do take care. And please, 2 days before the exam, full rest. No study, nothing. You need rest for your brain too. So that small thing is that risk free rate. Just want to read that part a little. Yes, it is this part. Nente currently pays interest at 7% per year on his loans, which is 380 basis point over the government base rate. So indirectly, 7 minus 3.8, you have to find the risk-free rate. You have to find the risk-free rate. That's what they are saying. You might have taken 7%, or you might have taken 3. You must have added 3.8 with 7%, or you might have taken 3.8% also. Okay, so in order for you not to make that mistake, to show you that mistake, I did this here. So with this, I end my series of revision kit solutions. Thanks for watching it, commenting it, liking it so much, and I really hope that it really helps millions of AFM students. And don't worry, inshallah, we all are together in this and you'll be passing AFM with flying colors. Do keep in your prayers and take care of your health and study well. Goodbye.